Hello and welcome to IG's Trading the Markets podcast. I'm Victoria Scholar. Now, gold broke above $2,000 an ounce for the first time ever this week, posting a fresh record high and logging another key milestone. Investors have been flocking to the precious metal this year amid demand for safe havens during the global pandemic and economic uncertainty. With me to discuss the outlook for gold is Dan Popescu. He's a consultant and analyst on gold, silver, and forex. Dan, great to have you on the podcast. Let's just start with this impressive move that we've seen for gold. I mean, what have you made of the pace of ascent of gold? Have you been surprised at all, or was this something that you were expecting?
I was not surprised. I wrote on my Twitter account when it hit when it was above 1800 that once the most important point resistance was the all-time high of 1920, and there will be maybe some resistance between 1920 and the psychological level of 2000. You have to keep in mind 2000, it's only a psychological limit if you want resistance. The real important number, the all-time high, was 1920. But you usually, when you have in technical analysis, they say when you cross a resistance, that resistance becomes support. So you have a retracement to the support, testing the support before it moves up. And I expected because there was those two numbers were so close, the technical, the all-time high of 1920 and the psychological round number of 2000, that maybe gold will move around between those numbers a little bit, and then once it crosses 2000, it's gonna speed up for a short period of time. And I wouldn't be surprised in about a week or 2 weeks to have some correction to test this support, psychological support, and all-time high of 1920 and 2000. So I expected it that once it crosses 1920, you have to keep in mind, and I sent you a chart before, and I put it on Twitter every morning, that gold has crossed the last currency, fiat currency was the US dollar. It crossed the Swiss franc, the Japanese yen in the last 2-3 weeks, and in all the other currencies. And in this monetary crisis, because that's the reason of the bull market in gold and silver, is that we're in a monetary crisis since 2008, and that is the reason. So gold is the currency of last resort. It is the etalon of all fiat currencies. So once it broke 1920 in all-time high and 2000, it's signal that it's the canary in a coal mine of the currency system, that something is wrong with the system. So I was not surprised. I said that when it crosses 1920, it will have some resistance at its psychological level of 2000, but then it's going to spike up. And that's what happened. To put something into perspective is that I don't see yet, some people talk about overbought territory. And in technical analysis, you have to be careful that in the early stages of a bull market, the price can stay in overbought territory for quite some time. So you have to be careful when you look at the overbought sentiment in the early stages at the beginning of a major bull market. So and what also I've looked out this morning, and all night I went over it. I wanted to see the sentiment, the general investor sentiment, and of the financial media. And contrary to the Nasdaq, when Nasdaq hits a new high, historical high, CNBC puts a tweet every time. I haven't seen one about gold 2000. So it doesn't seem to be yet that euphoria that you see that brings usually a correction.
Okay, Dan, just a quick question on what's sort of driving the demand for gold right now. You mentioned that we're in a sort of crisis when it comes to central banks. There's a theory out there that there's expected to be a pickup in inflation as a result of the trillions of dollars of stimulus that we're seeing both from governments and central banks around the world. We know that gold is often used as a hedge against rising price levels. How much do you think the demand is driven by an inflation hedge demand, and how much of it is about looking for safety amid the global pandemic?
Since 2008, it is a currency crisis. There are currency wars. Gold was in the shadows because it never really left the international monetary system. I put on every month an updated chart of the amount of gold official reserves, gold that central banks hold since the 1920s. And the high that was hit was in 1965. From 1965, it started to drop, and it stopped dropping in 2008 with the financial crisis. And since 2008, we see an increase in demand by central banks of gold, which indicates, and that's the canary in a coal mine in the currency system, international monetary system, that something is wrong with the international monetary system. We've known that since 1971, but it has been pushed and pushed and pushed, and it has survived. But from crisis to crisis, all people like me know that the dollar system that started in 1971 has not been a clean, straight move up. It has been a crisis of dollar and fiat currencies since 1970. If you look at the dollar index since 1971, you'll see that it has a lot of zigzag, incredible fluctuations. So it's not something new, but 2008 brought gold back into the international monetary system. It was in the shadow. It never left, but it was in the shadow. In 2008, central banks in the crisis refused to accept dollars or euros or anything else as guarantee. So they did swaps, incredible amount of swaps with gold reserves. And if you look at a chart of the global, world central bank gold reserves, you'll see that from the high in 1965, they only sold 23% of their stock of gold. And since 2008, they bought back 60% of the gold that they sold. So that's 20%. It's not an end of the gold standard. It shows that the central banks still consider gold, as Greenspan said, the etalon, the currency of last resort. What's important to your question, gold is at the core, the hedge against all of the currencies, not just the dollar. The dollar being the major currency with the euro. They dominate the international monetary system. The international reserves are dominated by 50% the US dollar, about 20% euros, and about 14% gold. So you see, those three dominate the international monetary system. In trade, the dollar has about 40, 45, 49% of the market, and the euro has about 40%, 38%, a 10% difference between the euro and the US dollar in international trade. What gold shows, because gold is going up not only in dollars, but also in euros, in Swiss francs, in yen, in yuan, it shows that the whole system is in trouble, and gold is the canary in the coal mine. Now, where is silver into that? Silver, contrary to a lot, even this morning I read articles by analysts who pretend to be currency and gold and silver experts, saying that silver will go up because the economy will come back, industrial use of silver. It's completely false. That is absolutely wrong. Silver in a monetary crisis dislocates from the industrial aspect and becomes a monetary metal, despite the fact that about 40% of its demand today is industrial. In monetary crisis, it becomes what we call poor man's gold, and it starts to correlate. Before before the recent move, I said that silver, people were asking me on Twitter, what do you think about silver? And I used to say, silver is not going to move until gold moves in all-time high. Silver waits for gold to give the signal, and then it starts moving in steroids faster than gold. And that's exactly what we've seen in the last 2 days. Gold crossed in all-time high territory, and silver right away behind started moving on steroids much faster than gold, bringing the ratio under, if you look at the channel that was creating, recent channel in the last 10 years of the ratio between gold and silver, it was very high. It went over 100, all-time high. And then now it has collapsed under the all-time high and collapsed under the uptrend and channel, and it's going down, and I expect it to go even. The higher gold goes, the faster silver will move, but silver is dependent on the movement of gold.
Okay, so you've talked about the fact that you're expecting a bit of a short-term pullback for gold, and that's likely to mean the same for silver. If we're looking a little bit further ahead, say in the next few months, what's your outlook for gold and silver?
Well, you said a few months. Let's put a limit to those few months to the end of the year 2020. There is an event happening in United States that has global impact, especially on currencies and markets, and that is the U.S. election at the beginning in the first week of November. That is a point that could change certain things. Right now, the markets expect Biden to win. And that's also one of the things that I'm quite sure has been bullish for the price of gold and the collapse of the dollar index. And that will continue. As the polls indicate that Biden might win, you'll see the dollar weakening and gold going even higher up to the election. Now, there are the two scenarios possible because polls are not always certain. And that is the scenario that, as a surprise, Trump comes back. It happened with Hillary Clinton in the last election, and then Trump comes back. So the market, the stock market, the American stock market is very, very bullish and likes Donald Trump because he cut taxes for the super rich. He cut taxes mostly for the stock market, which has been very bullish for the stock market, that if they see that Trump wins, let's say in the night of the election, Trump is being announced as a winner, then you're going to see a reversal, the dollar going up and the stock market starting to move up, the opposite of what happened 4 years ago. And you'll see gold retracing. That will be temporary because the monetary crisis will explode even more with Donald Trump. So after the small correction that you'll have, if there is a Trump win, you'll still have a continuation of the bull market in gold because of the currency system crisis and the collapse of the present and reset of the present system. So short term right now, until the election, as polls give Biden a winner and the market expects higher taxes and more printing of money, you'll see both the euro going up, maybe even breaking the 120 downturn channel that has started in 2008, and gold also continuing. I see a target in gold by the end of the year around 2,500. If Biden wins, I see a correction, so maybe correcting to about 1920, 2000 level, which are the supports if Donald Trump wins. So this is my projections, if you want, short.
Very interesting how politically dependent this precious metal is becoming as we head into the US election in November. Now, just changing focus very slightly, we've seen a lot of investors lately using ETFs to get exposure to gold. I mean, what are your thoughts about the rise of passive investing when it comes to precious metals rather than investing directly into the bullion?
Well, there are two aspects. You have to split it because it's not global, this demand for ETFs. The demand for ETFs actually, and for physical coins and bars started already at the end of 2019. There were lines in Germany of people wanting to buy gold, more specifically, but also silver coins. Because of Brexit, there was a high demand for physical coins and gold coins and silver coins in Great Britain. There was not demand, or very little demand, if you want, in North America of physical coins or ETF. You saw in German DAX ETF a high increase in demand in the end of 2019 and beginning of 2020. So it's not new, the demand for ETFs in Europe. The demand for ETFs in Asia, it's different. Asians usually don't buy ETFs. It's sophisticated, American-educated, rich Asians who buy financial products like ETFs, gold ETFs, or others. The population in India, in China, buys the physical gold. So the demand of ETFs lags, if you want, the physical demand of gold in Asia. But even in Asia, I sent you this morning a table from the World Gold Council and also a chart that the chart gives you not just the ETFs, but also the mutual funds. All put together is what we call the investment demand of gold, and it's in all high territory, historical, and has been for a few months already. And it's the same thing for silver. So the demand is basically, to answer precisely your question, is that everybody expects inflation, devalorization of the currency, confiscation of assets by government because of the printing of money. And coronavirus has amplified it. If you look at the money supply since the coronavirus, it's gone exponential, and the debt of United States and global debt has gone exponential. It has been my bull theory, long-term theory in 2002, 2004, when I first became bullish on gold again, that I see gold within 14 years from 2004, somewhere around between 4,000 and 6,000, averaged at 5,000. I expected it to happen around 2008 with the crisis, but the intervention of the central banks was so massive, and the IMF sold gold for about 400 tons of gold, which started a correction, a drop in the price of gold from 1,900 to about 1,100. So it's this monetary scare that people have, but not just individuals, which pushes the ETFs, but also pension funds and central banks. 2019 has been an incredible demand by central banks of gold. And a recent survey by the World Gold Council indicates that they will continue to buy gold. And the latest data that I had from last month shows that despite the coronavirus crisis and the economic slowdown, central banks are continuing to buy gold. Individuals, for the same reason, they are scared of hyperinflation. Now, I'm not so sure anymore that we're going to have hyperinflation, which will push gold to $10,000 or $15,000. I stick to my target of 5,000, 4,000 to 6,000. Let's move it because of the coronavirus to 6,000. And the reason I'd say that is that normally governments don't want to default because politically is dangerous for them. They lose their heads. It might produce revolutions. So they prefer inflation, and has been the case for 2,000 years since the Romans and before the Romans. Inflation is the easier way, or the way to push the revolution a few years in the future. But what happened with coronavirus makes me believe that we might have some inflation. We already have inflation, monetary inflation, but we might have a jubilee. That means that coronavirus makes it possible psychologically, socially, to accept a jubilee, which is a forgiveness of debts. And you see already discussions at the state level, at the G20, to forgive the debts of poor countries like Africa, South America, and in Asia. So that will decrease the possibility of a hyperinflation like in Russia, Argentina, or Zimbabwe, which will push gold to $15,000-$20,000, and make my projection of 6,000 more plausible, because part of it will be through a jubilee, and only part of it will be through high inflation, which would mean maybe 10%, 12, 15%, which is not hyperinflation.
All right. Sadly, that's all we have time for on today's podcast. Dan, thank you so much for your time and your fantastic answers.
Thank you, Victoria, and have a great day.
That was Dan Popescu, consultant and analyst on gold, silver, and forex. I'm Victoria Scholar, and thank you so much for listening to our podcast, IG Trading the Markets. And if you're a fan and you're enjoying our shows, please don't forget to subscribe and feel free to give us a review as well.